Money Radio for a really great future. We're talking real money.
Well, it's Saturday. That must mean it's time to talk about real money. Here on the program called Talking Real Money, that is both a radio show and then, magically later, a podcast. Thank you all for being a part of what we do. I'm Don McDonald, along with Tom Cock over there, and we are here to try to enlighten you about investing and saving and spending and living off of your money in retirement and all of those things you do with money in your life. 855-935-TALK is our telephone number. You know, it's an anachronism. It still calls. You just do it on different devices. 855-935-TALK. We love hearing from you. We'd love hearing your voice more than listening to ours that we're tired of. And one of the things that we sometimes grow tired of giving you the same advice all the time, but we're reminded now and again how important that repetition is, because most people still aren't getting it. There are some basics that you need to apply to your investment portfolio all the time, and we need to think about it too, Tom and me. And that is one of the things we just hammer on, and probably need to do even more, is this concept of diversification. We think you should have a diversified portfolio, but we realize it can be hard to do.
Yeah, diversification, by the way, this year is back in fashion, and you know how important it is, the two of us, to be in fashion.
Oh, yeah, I'm always such a fashion player.
You look at that shirt. Yeah. I think I remember it from 1995.
No, it's a new version of the same shirt.
Okay.
Yeah, I bought a new one.
Lined up, ready to go.
Yeah, I just line them up, yeah.
Yeah, because this year, if you're an investor, you know, we've had leadership primarily for the last decade. Actually, if you go back to the crisis of 2008, 2009, the stocks that have made the most money have been large U.S. companies, mostly technology related. Mm-hmm. That's it. I think we can pretty safely say that, even though recently we talked about the last 5 years, U.S. small cap value's done better. But a little longer that has been the case. This year, though, we've seen a change in what the people on the inside of this business called leadership. European equities, emerging markets, international small cap value, stocks that are not large U.S. tech firms have made more money. And it's reminded people again that, yeah, a bunch of your money should probably be invested other places than just, for example, the Standard & Poor's 500. But it's not easy. It's not easy to do, and it's not easy to maintain either. That's one of the points of this article we read recently.
Yeah, it's hard to do because we want to be where the money is being made. The problem is we confuse money being made with money that's been made and may not be made again in the future, which is the whole point of diversifying. You don't know what the next segment of the investment market is going to be the one that does well. And there's this Morningstar article that both of us really enjoyed, made that point. And by the way, we're guilty of not doing this.
Yeah.
There was a firm back in the 80s that was run by people who had lived through inflation in the 70s, which we did.
Yes, we did.
And they always put 5 or 10% of their clients' assets into gold or gold stocks. And they stopped doing it when their clients kept calling and saying, why are we in gold when it's not
made any
doing
money.
anything?
Yeah, it had a great run, and then people, and this is very typical, not of just individuals either, so don't make yourself feel bad, but of the investing professionals. They say, well, look at this. This has gone up and up and up. I got to make sure we got something in here. And in this case, it's going to protect us against inflation.
Yeah, and this is my beef with current asset allocation, and it's one of my beefs with Tom, is that his belief is that your portfolio that you set up today should reflect the current market as opposed to whatever the norm has been. And it's really hard to make that determination. That's another thing that makes it so hard. For example, how much is the right allocation between U.S. and international stocks?
Yeah, if you're going to do it on a market capitalization basis, that is the value of stocks in particular.
Market capitalization.
I'm getting to that.
Yeah.
Yeah, it's about 65% in the U.S., 35% outside of the U.S.
But that allocation is due to the incredible outperformance of U.S. stocks. So what it's saying is that you're not maintaining the balance that it was before.
You're still 50-50, right?
My argument is still 50-50. It's hard to get to 50-50.
Mm-hmm. Yeah.
You have to do it on your own because you can't do it in the funds because the funds just follow whatever the current allocation is.
Yeah, and this article makes a very good point, too, around the fact that many people, investors, again, and professionals in the 90s said, look, it's all about technology. You've got to pile into technology just in time for that to have a decade where the NASDAQ got creamed, and it took, I think, 10 years for it to get back to where it had been. It really got hammered there in the early 2000s.
Oh, yeah, it took it at least that because it took the S&P, not the TAC. It took the S&P 10 years. Right. To get into positive territory after the 2000s.
Yeah.
So tech was even longer. Mm-hmm. And I mean, and another great example is Japan. Japan has just recovered from.
You only had to wait 30 plus years. 1990. Yeah. Till 2024.
35-year downturn. 34-year downturn.
But how can you do better? Let's talk about that.
Well, and that's the whole point. We want to do better. How well should we expect to do, too?
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at talkingrealmoney.com or call 800-386-3004. That's talkingrealmoney.com because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
Your guides to a really great financial future. Tom and Don are talking real money.
Diversifying is hard. We get it. And it's tough to overcome your emotional concerns and needs and fears and wants. But what should you do? How should you become properly diversified?
Well, I think there's a couple of things that this article points out, and that is probably for most people in today's world, you can just use one fund. I mean, you can use a fund like an AVGE or a DFAW. That does the diversification for you. It's all right there. Or VT. That's pretty easy. The other one that I think is really important, and frankly, having read it, I thought, I'm guilty of this, and that is stop measuring the performance of individual parts of a diversified portfolio, i.e. the S&P 500, against the globally diversified portfolio. I do it all the time, right? I even do it on the show. Like, hey, how's the S&P done?
You do it all the time.
I know, it's bad.
It's because, at least we've stopped saying the term Dow.
That's true.
But it's because it gets quoted all the time.
Yeah,
so
it does.
People think of it as the market, and so we tend to compare with that, and it is an unfair comparison. As a matter of fact, because of the overall lower volatility of an international portfolio, your expectations at certain times should be for underperformance. Other times, there may be outperformance.
Yeah, and I will mention before we go to the phones, and thank you for your calls, that from IFA.com, they keep track of all these things. 1931 through the end of September 2025, the 100% global portfolio, that is massive diversification, annualized return 11.7%. The S&P 500, 10.1, so 1.5% more per year on the global. Not saying that'll happen this year, next year. Who knows?
And that's not been the case recently, except in the past year.
That's right.
855-935-TALK is the phone number. That gets you here. You can ask us questions, have a conversation with us about your money issues, and we love to help you. So give us a call. anytime on Saturday between noon and 2 Pacific time, 3 to 5 Eastern. Let's go out to our nation's capital, Washington, D.C. Charlie, welcome to the show.
I could use some of your rain back here. We're having like a mini drought.
I'll be glad to send you some, too, by the way. Not a problem since we've had, I don't know, an inch in the last day. God, yesterday was a real downpour. Don's doubting that, but I'm going to look it up. It was a lot of rain yesterday. I'm going to look that up right now.
We get an inch in 15 minutes. Anyway, go ahead.
We had a lot of that rain back in May. My question has to do with mutual funds, and I always thought it was pretty smart. I've been listening to you guys about a year, learned a lot, more than I thought I did. And then, but you keep mentioning Avantis and Dimension. Am I pronouncing them right?
Yeah, Avantis and Dimensional. Correct.
I'm getting, but most of my dealings are with the outfits I deal with, which is Rowe Price and Vanguard. But I'm wondering, if I have brokerage accounts with them, can you buy some other outfits mutual funds?
Sure, it depends. Yeah, basically. I mean,
with Vanguard, I don't know about Rowe Price because I didn't know they had a brokerage account. I think.
Yeah.
By the way, I know they're Baltimore. I know they're in the area, but I would probably skip Rowe Price because they're actively managed and therefore a little bit more expensive. But through Vanguard, through their brokerage account, you can buy the Avantis funds, the Avantis ETFs, and the DFA ETFs, not their funds.
Yeah, and this is always a bit of a moving target, Charlie, because these things change from time to time. So different companies sometimes say, well, we're not making any money on that transaction, therefore we're not going to offer it. So it does switch around from time. But, I mean, it's easy to find out. Just go to the website of which you use and type in the ticker.
Yeah.
But if let's say, even with Rowe Price, if I buy, just give me one of the Avantis funds.
AVUV? AVUV.
Okay, AVUV. All right, let's say I wanted to buy 1,000 shares of that to T-Row in my brokerage account.
Yep.
I mean, once it's in the account, they're not managing it. That Avantis is.
That's correct.
That's right. Yes.
And everything, and if that fund pays a dividend, it's going to show up. They can't affect what Avantis is doing.
I'm trying to make sure I'm understanding what you're saying. No, the money. That's right. They're just the custodian. They're the bank holding your money for you. That's correct.
Okay. All right. Okay. Well, this is one of the naive things.
No. This is it's a very legit question, and I looked it up. Yeah, I've just never looked at it. T. Rowe Price does have a brokerage account with 0 commissions on ETF transactions. And it looks like you can do Avantis and Dimensional through them because they're publicly traded with 0 commissions. So you just would place an order for those securities. Then that particular part of the portfolio is managed by Avantis, just like another part might be managed by Vanguard.
Now, in a lot of the traditional mutual funds I have at both of those companies, unless it says so, how do you know really what indication of titling would indicate if it has any international exposure?
Well, they would say in the name, global.
Well, and you can just go to Morningstar and type in the ticker. It'll tell you exactly what you own.
Or if it's
great resource, by the way. Go to Morningstar. For example, if I go into Morningstar right now.
And it's free.
And I type in AVUV.
Yep. It'll give you the portfolio compensation.
That is a U.S. small cap value, which means it has no international. But if I type in AVGE, which is the Avantis All Equity portfolio, and I click on the portfolio button in Morningstar, that tells me that it is 70% U.S. and 30% international. So you can look it up. It's a great resource, and it's free.
Fabulous.
Go to Morningstar.com and just type in the symbols of any security you want to look up. And they're going to give you so much information you won't know what to do with most of it. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
Welcome back to our little get-together that is a radio show and a podcast, too. When it's a radio show, though, you can call us at 855-935-TALK. That's 855-935-8255. And it's really, really easy, and we'll talk about almost anything. Now we're going to go down to California, which is kind of like saying we're going to go out to Norway, because it's like the size of a country. Gabe, you're up. Welcome to Talking Real Money.
Hi, guys. Good afternoon. My question is about when to start investing instead of paying down debt. I have 3 different kinds of debts. I have two mortgages actually on 2 houses, and I have a car loan as well. So all 3 of them averages about just under 5%. And in the past, in your show, you guys said if your debt costs you less than 6%, maybe we should just invest that money. I wanna dig into my debt though. So of the 3 debts, one of my mortgages cost me 6.5%. So what do I do? Do I go and do I pay off my 6.5% debt that I have, or do I get the average and then decide from there?
It's great questions, by the way. I'm going to correct you slightly. I believe I said any debt greater than 5% should be probably paid off. That's kind of the cut line for me.
Before Tom gets into his answer, though, I want to ask a question. You said, paying off the debt versus investing. Why do you own 2 houses?
Well, I have college-age kids, and they want to go to a certain school down in Southern California, and I have 3 of them, and I want all of them to go there. And eventually, my wife and I are going to move there. So,
got it. Okay.
In other words,
all right.
long-term.
I just wanted to find out whether this is an investment property or it's a second home. Basically, it's a second home.
Yes, it is.
Okay. So, and in a general sense, mortgage debt, most of the time viewed as okay, right? It's okay to owe something on a house. So, and part 2 of that is, as we get older, we'd prefer to see you stay more liquid. So we get many times people say, well, I want to pay off my mortgage with $200,000 I have here. And I say, that's money you may need to pay the bills when you get older. Car loans, I'm not a fan of car loans, and I know you can get some great interest rates on those still today. I'd probably start with that one, pay that one down, pay it off, leave the mortgages as they are, and then after I paid the car, I'd probably start investing from there. But what's your take, Don?
Well, I think it's a bad idea to say anything bad about the Corleones.
I'm well insulated here. They could never find their way this far. You, on the other hand.
Here's the way I look at it. It really depends upon you and how you are likely to invest. If you're comfortable with taking a bit more risk, the data tells us that you should even exceed the 6.5. Should. Yeah. That you're paying, and so therefore, and you don't even have to go into a crazy risky portfolio. Therefore, back to Tom's point of not tying up the capital in the house, I think that mortgages tend to be 6 is okay. It's not great. It's okay. That might be something I'd keep an eye on refinancing, though, if interest rates ever go down. If you get a drop down to 2 point or 4 point something or 5,
I'd say 5 probably.
5, yeah.
Hope 5. For 5. Yeah.
What's the rate on the car loan?
The car loan is at 5.75.
See, that one I'd be more tempted to pay off than the mortgage.
Me too. I'd pay that first and then look at the situation. Yeah.
Yeah, I know. Yeah. So I guess my question is, do I look at them in totality and take the average of these interest rates, or do I look at them individually and then go from there?
Yep, pay the car. Yep, and then figure it out. And then if you can start saving,
I would
start
pay
saving
the
from
car,
there.
skip paying off the mortgage. Wait, which mortgage is it, by the way? Is it the house you're in now or the house you're going to be in?
No, it's well, actually, I have the house now. As a matter of fact, I just refinanced it from 7.6 to 6.5 just a couple weeks ago.
Wow. Which house is this, though?
I'm keeping this is the second home.
The one in California.
You're going to move to.
Southern California. Yeah, the one you're going to move to. Okay.
Exactly.
I'm with Tom. I'd pay off the car just because that's safe short-term money. That's safe and short-term. The mortgage is longer-term money, and I would probably not pay that off. I would tend to want to invest it, just like Tom said. Thanks so much for the call. 855-935-TALK is our number, and we do have lines open.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Hey, welcome to our not-so-spooky Saturday. We don't do anything for the Halloween. We did nothing.
I did something. I carved 2 pumpkins last night.
Did you?
I did. My grandsons are here, and we did too.
In the rain.
And well, I keep them under cover. They'd be already rotted. So, yeah.
855-935-8255. That is the phone number. We lost a caller, so the lines are wide open for you right now. 855-935-TALK. And good news. Is it good news? Well, it's semi-good news. Some people don't think it's very good news, but there is some good news, I guess. If you think more money is good news, no matter how much it might be, then there's good news on the Social Security front, and there's so little good news about Social Security that we better just enjoy this while we can.
But those intrepid few that are still, I guess, going to the Social Security office, I don't know how that all works.
There's no one there.
Oh, okay. So some other person just showed up and decided to issue this edict?
Apparently.
I see. Okay. Well, all right.
It was probably AI.
I'm asking all of you, on average, how do you plan on spending that extra $102 a month next year?
I think I get a little more than that.
I think you do. The average benefit Social Security will be $2,064 a month. That's the 53 million people receiving Social Security. Don is among them. $56 more a month because the COLA, cost of living adjustment, 2.8% in 2026.
Yeah, I just
if you're on Social Security.
Mine's only like 120. That's not much.
I know. So I'm asking you, and by the way, this comes at a time when, and I just looked this up, coffee, do you know how much coffee's up in the last year?
$120?
About, depends on your house. 19%. Beef up 18%. I mean, there's a lot of things that a lot of people rely on.
I just read an article in the Wall Street Journal about the Halloween candy and how much of it doesn't have chocolate in it anymore.
You forget
because
that.
Chocolate prices have gone through the roof.
Oh, okay. So there you go. But yeah,
which is bad for you.
Yeah, it is bad for me.
Well, good. It's good for you too, in a way.
So
it's kind of like Social Security. Good news, bad news. You're getting more money, as much as you should.
And then you read further down the article, and I just absolutely hate reading this. Among Americans ages 65 and older, 40%, almost half, rely on Social Security for half or more of their income. I thought it was a great higher number than that.
I thought it was higher than that.
Yeah. I thought I read once it was 65% that rely, like 80% of their income. And by the way, people polled by AARP found that 72% of adults ages 50 and older said they would need at least 5% to keep up with rising prices. Sure. I mean, I think it's very hard to do this coast to coast for one thing, because costs increase dramatically differently in one locale.
Places.
Yeah,
absolutely.
But you're going to get more. Yeah. As you said, it's not great.
What number did you have?
It says
I got the number
from the Journal.
Social Security.
This from the Journal says 40% rely on Social Security for half of their income.
From the Social Security Administration
what do they say?
51 to 56% rely on Social Security for half of their income.
Yeah, okay. So
half or more.
I think I'd read it greater, yeah.
27% rely on it as their only source of income.
Which is really tough. Really tough. And then you get this, fairly minor increase. So, as you said, it's any more money's good. I suppose more, I guess.
Yeah,
so.
it means probably I'm going to get enough to pay for the bags of chocolate that the trick-or-treaters are going to eat when they come to our door.
You get like 1,000 people to your house.
We only get 500 to 600.
Oh, pardon me. We might get 5 or 6
in a good year. But this year, Halloween falls on a
Friday,
which means
more people.
More people.
Yeah, of course. More than Tuesday.
It means more people, and plus it's going to be perfect weather. The high on the 31st in Orlando It's going to be 73 degrees. Zero chance of
living
rain.
the life there. Wow. Yeah. I might come down if you got. What are you giving out?
The little bars. The little bars. We don't do the
which
big
ones?
bars.
Which ones?
Well, we generally do the little Snickers.
Okay, I'll do
Twix,
Snickers.
Kit Kats.
Yeah. Okay. So far, so good.
Reese's peanut butter cups. M&Ms.
You're hitting your 4 for 4, man. Keep it going.
Yeah. I think
I'm on my way.
occasionally get Sour Patch Kids, which I
Not
can't
me.
stand.
No,
I hate those things.
No. If I'm going to kill myself, it'll be with chocolate.
I'm a
pretty
traditionalist.
much. Yeah. Sorry.
But anyway. The funny thing is they're right. You open up those little packages, and the little bars are a little bit babier. They're just tiny bit smaller.
There's a name for that, and I forget what it is now.
Shrinkflation.
That's right, shrinkflation.
Shrinkflation.
Yeah. Okay.
And, by the way, just a plug for my Lit Reading podcast.
That's not the one I like. It's the other one, or the other one's
New Tales
better.
Told.
Oh, I love that one.
New Tales Told.
Yeah, I've listened to a couple of them.
Lit Reading, I've put up a story. I think I've got 20 Halloween stories up on Lit Reading right now.
Trying to scare up a little more business, are you?
Stories. I'm trying to scare up more business. I call it Scary Story Season.
Yeah.
And the latest. I think the newest one will be on Tuesday. I think I'm doing a really great Philip K. Dick story called The Hanging Man. Oh, it's so good.
The problem that for me, you got to ace out World War II, Planet Money, or one of the other ones where they talk about people that steal. It's a tough deal.
But here's the thing, is that you can listen to the ones about, like murder, Dateline, and all those things.
Now,
and
listen
the murder
to those
stories.
Right, okay, yeah.
Or you can listen to politics, or you can listen to World War. They're all depressing.
Well, I don't know. Yeah, you're right. Planet Money's not depressing. It's pretty educational.
Yeah. Well, it kind of can be depressing when they talk about the numbers.
Yeah, right.
And he still says the Dow. Kai Ryssdal still says the Dow.
Drives me crazy.
Stop it.
Yeah, no, that's a very silly. You can't even call it an index.
But the reason I'm mentioning that is because a lot of people this time of year go, I want some scary stories. Well, these are classical scary stories. So
all right, I might try one on my limited commute. We'll see.
Yeah, you might.
Okay.
They're kind of fun. And I guarantee you'll like The Hanging Man. It's a
depends who the man who's hanging.
Yeah.
That's
not you. 855, and that comes out on Tuesday. 855-935-TALK is our number. Give us a call.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
I was trying to think of a way to make it easier for you to find my other kinds of podcasts, my short story podcast, and I thought, I wonder if you can just search Don McDonald on the podcast services. So I tried that.
Go to Apple Podcasts and search
and
Don
just type in Don McDonald, and I got Talking Real Money with Tom Cock. There it is. Mm-hmm. Lit Reading, L-I-T reading.
Sure.
Talking Real Money Minute from way back.
That's going back like 10 years.
Yeah, that's because it says Vestry on that.
Uh-huh.
Then I get the Informed Chiropractor.
Good old Don McDonald. You're cracking it up, huh?
Don MacDonald.
Don MacDonald.
And then after him is Rita Storis, my kid's story podcast. And after that is New Tales Told. So they fit a chiropractor in the middle there somehow. I'm not sure how.
My grandsons who love your Friday podcast think you're one of the richer people in the world because you're McDonald's.
Oh.
They always say, McDonald, he's your friend? I'm like, yeah. Then why does this milkshake cost you, Grandpa? You got to make money, too. It's just the way it goes.
I don't give away my milkshakes.
Exactly.
You might get free fries with the purchase.
I see.
But
never got that either,
That's all I'm
by the
giving
way.
you.
All right.
855-935-TALK. We still have a lot of time left in the hour. And, of course, we would rather talk to you than talk to each other. Because we talk to each other every damn day.
No, I give you Sundays off now.
Not always. Sometimes you text me on Sundays, particularly if there's a Raiders game or a Broncos game.
Good point, yeah.
Yeah,
okay.
or if the Broncos are doing really badly before a huge comeback.
Then you might get a note, shockingly.
I might get a note, like what the heck just happened?
Okay, fair enough.
So anyway, we lost Donna, so we have nobody. 855-935-TALK is the number. You can also send questions in at talkingrealmoney.com. And Tom has one of those right
Yeah,
there.
I get a lot of them. I think this guy wants to be known as Victor from New Jersey, so I hope that's right.
Okay.
He signed up one way, and then later
even though he was George from Oregon.
He doesn't want people to know who he is because he's 36 years old and he has $3.7 million saved.
I wouldn't want anybody to know who I was either. They're going to start asking for money. What? How much?
He's 3.7. He says if he sells a condo, he can make it closer to $4 million.
Damn, sell the condo.
And he mentions he has a high-income job. Well, that could have been figured. And that's making him seriously consider early retirement. I've heard much talk about the 5% flexible withdrawal rate, but I'm not referring to the method with the correct name. Each year, withdrawing 5% of the portfolio's value each year. Yeah. Mm-hmm. Recently, I heard you guys mention, in practice, 100% success rate with this method. I can definitely survive on $200,000 a year. Currently, my wife and I live on much less than that. Biggest expense of income tax. The question really here he gets to, can I consider using the 5% withdrawal method? Do you want to describe what that is very quickly?
Yeah. It's so simple. It's just ridiculously simple. At a particular date, and I like doing it this way. On the first of the year, or the last day of the year, depending on what your tax situation looks like. You can
do it now for next year because it's been so good
for tax planning. But what you do right at the end of the year or right at the beginning of the year, you take out 5% of your portfolio's value as of that date.
The
value of the portfolio.
Yep. That's right.
So in your case, how much do you have? 3.6 million?
Well, roll it up to 4. Be easier to do.
4.
Yeah.
Okay. So with 4, you're going to take out $200,000 on approximately January 1st. You're going to put that in a high-yield savings account connected to your checking account, and then you're going to start living on that money. You're going to create yourself a budget for that year of $200,000, all inclusive. Yeah. Now, if an emergency arises, you always have other assets you can tap. You can sell things to do that. Then next year, let's say it goes down to 3.6 million.
Yeah.
Next year, you're going to be taking out 180,000 as your.
So you have to learn to live on less sometimes.
You have to budget. You have to know that you're going to be able to budget.
No.
And if your portfolio is properly diversified, that variation shouldn't be incredibly painful. You shouldn't see a 50% decline as you would in a 100% equity portfolio.
Yeah, part one would always be to decide the stock to bond ratio. But he says, can I consider using the 5% withdrawal method for a 50 to 60 year retirement timeline?
Yes.
No.
Yes.
It's just too long.
Why?
It's just
Why?
For me, it's just because I don't know how things are going to be 20 years from now.
Okay, but the rules still apply because we've run Monte Carlos out to 30 plus years.
I wouldn't do it that way.
100%.
Yeah, I just think I think when you get past 30 years, too many unknowns. But does it? If I put it in my Monte Carlo tomorrow, sure, it'll work. He says I will not rely on these presumptions. He says I've been listening for over 15 years. So you've been listening since he was 21 years. To every single podcast you put out, absolutely fantastic. You've been life-changing for me. And by the way, it doesn't say positive life change or negative life change. Because it could go either way. People say that was a life change. Oh, okay, that could be bad. This always gets back to the FIRE movement and all the rest of it. Like, should you plan on... I just think it's a long... Well, I would go absolutely insane not working for that long a period.
All right, here, if we meet the historical after-tax mean for a 60-40 portfolio with a flexible withdrawal, I come up with a 60 years, 95% probability of success, 95% success ratio. And it could be better than that.
95 is off the charts. Yeah, sure.
It's so close.
Yeah.
I mean, because
there's just so many things that can happen in your life in 50 or 60 years. It's a long time.
Here's my argument, and I don't care what people say. I get all these nasty notes. Well, I could retire. What are you going to do?
No, I was just getting to that. Yeah, no, I concur.
I bet you're going to want to do something that makes money. I am willing to bet you're not just going to want to do...
Well, it sounds like he's pretty successful at that.
Exactly, because you're one of these people who just wants to do things that are good, and you can make money from those good things.
Tom and Don are talking real money.
Hi, Don McDonald here. So, what's your plan for retirement? No, really. What's the actual plan? Because hoping the market goes up, stockpiling random investments, and praying your gut instincts are smarter than Wall Street is not a plan. It's a guess. And when the market gets bumpy, and it always does, guessing leads to second guessing. And second guessing leads to panicking. That's why you need more than a portfolio. You need a purpose, a strategy, a real financial plan built just for you by a 100% fiduciary advisor who's legally obligated to act in your best interest. Imagine that. Start your plan today with a free, no-pressure meeting at talkingrealmoney.com or call 800-386-3004. That's talkingrealmoney.com, because your future deserves more than crossed fingers and wishful thinking. By the way, no sales pitch, no obligation, just smart help for real people who want to stop guessing and start planning. Appella is an SEC-registered investment advisor. See AppellaWealth.com or the firm's Form ADV for more details.
For your real life and real future, Tom and Don are talking real money.
I aired. I did it on. I did not make that a 5% flexible. I made that a 5% withdrawal rate without inflation, just fine. And so that's why it was 95%. Of course, if it's 5% flexible, it's 100%.
It's 100. Yeah,
it's always 100. Yeah.
Again, you mentioned the engagement. What are you going to do for purpose? I think that's something that people should think very long and hard, especially somebody who's been successful so young. Part two is, again, in 50 or 60 years, a lot can change in your life that might make $200,000 look like nothing. I don't know. What about divorce? What about death? What about other stuff?
With a 5% flexible withdrawal rate, if the portfolio is either too conservative or too aggressive, you could end up getting $200,000 or less every year for decades, conceivably.
Right. Well, what if stocks don't make anything for 20 years?
Right. I mean,
you're never going to keep shrinking.
But you're never going to run out of money.
No. That last year you're going to get $1.50, but you're still going to get it.
More than $1.50.
I know. It's just a long time. That would concern me for anything.
Again, if I was talking with him, I would go, seriously, what are you going to do?
Yeah.
What is it? Traveling may seem like fun today, but
$200K a year on 200. That's not that much traveling
either. That's not that much money. No, it's not.
No, it's not.
What are you going to do?
Yeah, I think that's fair.
I mean, really, there's only so much golf or bridge or
more bridge than golf at $200K. No offense, because the cards aren't that expensive. So.
I'd be bored, and it's so funny every time I pull back on one thing, I fill the time with something else.
Yeah, well, you've got all these other podcasts you're doing now, which
so
I love.
many things that I like doing. I just like doing things.
I know.
I love creating stuff. Absolutely adore creating stuff.
You do. I've got a quote for you. Maybe this is going to be a future podcast. I just read this.
Is it a good quote? Okay, go ahead.
It's pretty fascinating about bubbles. Not the ones in your bathtub.
Tiny bubbles.
Yeah, not those either, sadly. They're talking about, this is an article about bubbles and why people can't really admit that they're in whatever it is about, financial bubbles.
Well, you never
like
know you're in a bubble. You don't know you're in a bubble until it pops.
Well, here's a market historian. I've never heard of him. Charles Kindleberger summed it up this way. There's nothing so disturbing to one's well-being and judgment as to see a friend get rich. In other words, people just keep buying this stuff because they're looking at their neighbor going, well, he's getting rich. I got to get some of this. The grass is greener, the jealousy, whatever it is. That's fascinating psychology.
Yeah, I don't know that I totally buy it.
I don't know. It's pretty.
Carl Kindleberger?
Yeah. No, Charles Kindleberger. I don't know him. It calls him a great historian of financial crises.
He was an American economist and historian.
Yeah.
Oh, my gosh, yes. He was a professor at MIT. He worked for the U.S. Treasury and the Federal Reserve during WW2.
Well, then you're going back a few years.
His big claim to fame?
Yeah, he called the 08.
He helped design the Marshall Plan.
Oh, very good. Yeah. Pretty important stuff.
And he wrote a book in 1978 called Manias, Panics, and Crashes.
That's where this comes from,
History of Financial Crisis.
And I'd forgotten, by the way, according to this article, that if you added .com to a company's name, that was good for a 74% rise in the stock over the next week. Back in the day. Yeah, that's crazy. Sure, we're a .com. Of course we are. Oh, okay, there's 75%.
The opinions and views expressed in this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions.
Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy.
Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.